Remember that prices are set on the margin. They aren't set through the whole value chain. 4 times change in demand. JPMorgan Chase also estimates, and they say it's an estimate because they didn't have accurate records then, that in 1980 and 1981, they believe the market share for precious metals and precious metals related assets in the US market was above 5 and, quote, perhaps substantially above 5%. So if rather than merely returning to mean in the US market, if demand for precious metals, or rather, pardon me, if precious metals market share took out the old nominal highs, then you have a truly goofy number.
According to a report by JPMorgan Bank, gold prices will continue to increase in 2024 because of the benefits of reduced interest rates. Gold prices tend to increase in the medium and long term, and gold's gains will last through 2025. As the president and CEO of Sprott U.S. Holdings Incorporate, RickRule brings extensive expertise to discussions about the gold market. In his assessment, RickRule discerns that the recent upswing in gold price diverges from typical retail demand, attributing it to central bank acquisitions. This divergence from retail activity explains why gold stocks haven't mirrored the price surge. One of the most striking developments over the past several years has been the historic demand from central banks. These institutions have been accumulating gold unprecedentedly as they seek to reduce dependence on the US dollar and create an alternative global reserve currency. Rick is right that smart investors remember gold miners failing to deliver value in the last major bull market. Regarding the gold market, Rick references JPMorgan Chase's 1980s estimate that the U.S. market's share of precious metals and related assets may have exceeded 5%. He suggests that demand surpassing previous highs could lead to significant price anomalies. Gold reached an all-time intraday high of $2,265 on April 2, 2024. However, when adjusting for inflation, the all-time high was equal to over $3,300 in February 1980 in 2024 dollars, amid soaring inflation and rising interest rates. From a technician's perspective, Rick highlights the potential for unexpected outcomes in market dynamics, emphasizing the importance of understanding supply and demand nuances. Now, we present the clips of RickRule's insights from his recent interview with Mike Maloney. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
The first is that the increase that you've seen in the gold price hasn't come from retail buying. In fact, if you look statistically at the precious metals ETFs, what you've seen is retail selling in Europe and the United States. The buying has taken place by central banks. And I think that's the key reason why the gold stocks haven't moved. Central banks don't buy gold stocks, they buy gold. If you begin to overlay retail buying on the central bank buying that you've seen over the last 2 years, then I think you see an explosive move in the gold price. And I think at that point in time, it probably carries through to the stocks too. The second comment that I have for you is that the generalist investor still can't spell gold. They don't care. They think that in an inflationary period, that they do better with technology companies that have high operating margins. Guard against inflation is a hugely profitable business. There's some truth to that. You know, Buffett did extraordinarily well through the decade of the 70s by focusing on companies that had pricing power. And I don't discourage people from looking at that, but I also do think that people need to pay much more attention to inflation protection that is easy to understand. The difference between gold and say NVIDIA is that it's pretty easy to pronounce and understand gold. And NVIDIA, I just hope I got right. The third comment I would have, however, is that interest in gold among young people and non-traditional people is increasing very rapidly. What I would like to do in terms of my discussion about the gold market is keep expectations rational, keep expectations real. Remember that prices are set on the margin. They aren't set through the whole value chain. 4 times change in demand, given that not all of the gold that's held is held available for sale. could have dramatic increases in price. JPMorgan Chase also estimates, and they say it's an estimate because they didn't have accurate records then, that in 1980 and 1981, that they believe the market share for precious metals and precious metals related assets in the US market was above 5 and, quote, perhaps substantially above 5%. So if rather than merely returning to mean in the US market, if precious metals market share took out the old nominal highs, then you have a truly goofy number. The truth is, however, that too many gold positive channels try to appeal to people's emotions. They try to give them really wild clickbait headlines. And I don't want to do that. I want my audience to be prepared for simple arithmetic. And the simple arithmetic is dramatic enough.
Despite JPMorgan Chase's data indicating a modest market share for precious metals in the U.S., RickRule remains optimistic about the potential for significant demand growth. He believes that restoring the historical average of 2% market share could drive a significant surge in demand, bolstering his positive outlook on gold and silver. American investors' faith in the precious metal hit its highest level since 2012 last year, and a Gallup poll showed respondents were more confident investing in gold than stocks. Gold's rally coincides with a reasonably flat US dollar, which also typically gains value during market distress. The DXY is up 1% year-to-date and down 2% over the last year. In his remarks, Rick emphasizes the rapid impact of various fears on the prices of precious metals. He focuses on investors' concerns about maintaining purchasing power in fiat currencies and the risks associated with excessive currency printing. Gold's recent surge isn't just a US dollar story. The precious metal is also making historic breakouts in various currencies worldwide, from the Japanese yen to the Chinese yuan and Indian rupee. This global phenomenon underscores the universal appeal of gold as a store of value and a means of preserving purchasing power. Let's get back to the interview.
JPMorgan Chase suggests that the market share of precious metals and precious metals investments in the US market, where JPMorgan Chase can track it, is estimated to be below 0.5%, which is to say,
Wow.
suggest that less than 0.5% of all savings and investment assets in the United States are comprised of precious metals and precious metals related investments. What's interesting about their statistics is that they theorize that the 4-decade mean market share was 2%. So if you merely revert to mean, demand for precious metals increases fourfold in the largest savings and investment market in the world. To put that in context, the US market controls between 22 and 23% of savings and investment assets on the globe, including foreign investments in the United States. If you had reversion to mean, you would see a quadrupling in demand in a market that comprises between 22 and 23% of the total market for savings and investment assets on the planet. That's precisely what I think is going to happen, which is one of the reasons why I'm so bullish about gold and silver. In my experience, the immediate impact of a variety of fears can impact the precious metals price. Looking at history, the most important variable is the one that you track, which is to say the fear that savers and investors have about the maintenance of their purchasing power in fiat currencies. In the very near term, I think what happens, I think I've observed this over 50 years being involved with investors, is that as investors begin to feel the fear associated with the deterioration of their purchasing power, they use any psychological excuse to express that fear. And so war, or the threat of war, becomes the excuse to exercise a strategy that they were already considering as a consequence of financial fears. Now, the second part of your statement is very profound. The want of societies around the world to exercise their political will, given the unwillingness of their own citizens to pay for it, means that they have to borrow or they have to print to wage these wars. Printing new specious currency units without doing anything to increase the underlying value of the economy always undermines the value of the existing currency units. If you have, let's say, 1 trillion currency units, call it what you want. Let's call them Mikes just for fun. And Mike decides that he's going to print 200 billion more Mikes to keep the trillion already in existence company without doing anything to increase Mike's net worth or his income or the utility he generates. What he's done is basically devalued the existing stock by the amount that he's added. And there's no particular difference between a Mike and a dollar. They're both specious currency units.
Projections indicate that gold will surge much further in the coming years, with analysts foreseeing prices continuing to climb into 2025. This trajectory, coupled with the anticipated growth in gold mining stocks, paints a compelling narrative of a golden opportunity. How do you see your approach to precious metals investments shifting in response to ongoing developments? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.